Hello and welcome back to the IB Investor channel. In this video we'll take a look at the AQ Group, a Swedish serial acquirer within industry companies. In this video we're going to cover a short introduction of AQ Group, the share price development, the sales and profitability, cash flows, the debt situation, and also the CEO remark. The company was founded in 1994. AQ Group is a global manufacturer of components and systems for industrial customers with high demands. And I would just assume when hearing that the company would, probably supply goods to maybe the car manufacturing industry, maybe the truck manufacturing industry, because oftentimes those are the ones with very high demands and often offers good volumes to their suppliers. AQ Group also consists of about 40 operational subsidiaries in some 40 countries, divided into 6 business areas right now. Now, firstly, for the share price development for this company, we can see that the share price has returned very well for the long-term investors. A combined return of more than 8,300% for this period. We can also see if you held the stock here for just 1 year, the total return within including dividends here or reinvesting dividends into more shares, you received a return of 63%, which is very strong considering the market climate that we're in. And we can see here for the 3-year period a total return of 142%. And the 5-year period here, a total return of 236%. So very, very strong. And you can also see the difference here. So the 5-year period here does not include dividends. It doesn't include the reinvestments here, but this number does. So very strong development here for the share in the short term, medium term, and the long term. So this is certainly one of those compounders you would like to own. Unfortunately, I don't own it myself, just looking from the sidelines here, but very good development here in the share, certainly, and very good for shareholders. Now for the income statement for this company, we can see that net sales has been growing pretty well. We had a small decline here year over year in 2020 from 2019. But other than that, it has been growing for the long term, which is very nice for investors to see. We can see the EPS growth here in orange, which has been growing over time. However, they had a slip here for 2 years where the EPS growth were a decline for 2 years in a row, which is not very good. We can also see here the profit margin here, the gross margin here at 51.3% here for the most recent quarter, which is very good. However, they did have a higher gross margin here in 2020, actually, that sat at 54.4%. Looking at the profit margin here for the most recent quarter, sits at 7.2% here in the most recent quarter. And they also had a similar development here in 2016, also at 7.2%. However, here when we have the the EPS decline here, they had a profit margin here at only 3.2%, which is, less than half that of what today. So big difference. Now for the free cash flow margin, we can see that they currently have a 7.1% free cash flow margin, which is good, obviously, but we can see for many years here it's been, going up and forth, which is kind of difficult to predict where this is going, whether, the margins are going down in the coming quarters or not. It's very, difficult to determine considering the history here. But currently it sits at a positive one, which is very good. We can also compare it here to AdTech, one of the peers here at 7.1, so very similar, and Indutrade here at much lower. So this is just comparing it apple to apples in the most recent quarter and nothing else. This paints a very similar picture. We can see that the free cash flow in kroners per share was very strong, as we saw in the previous picture as well, which is good. However, there are some negative ones here as well, as we mentioned here in the previous slide. And I can also see that the company has not really diluted the shareholders by issuing more shares. They only issued like 300,000 shares from 2016 to the next year or something like this. So the dilution is certainly under control. They're not diluting the shareholders. So per share, these numbers are very accurate and very similar then to the margins here that we saw previously. Now for the cash flow overview, we can see here that the cash from operations here in blue are growing over time. However, they had some slips here where, the cash from operations went down. We can also see here actually in recent time in 2021, 2022 that the cash from operations has been quite weak. We can also see the capex here, or the investing side of the business, that they have had some ups and downs concerning the investing side. Probably made some acquisitions here along the road too, but nothing worrisome, especially not here. I mean, we can see that the cash from operations well covers all the investing that they need to do. We can also see that they're posting a quite strong, or very strong, free cash flow here, which is very nice to see. But I wouldn't say that this is anything alarming right now, especially not with these figures being the most recent ones. However, I would like to see the cash from operations being more steady over time, but that's the only negative part that I can see right now in the most recent time, at least here. So yeah. Now for the debt situation of this company, and yeah, we can see that the net debt here in blue has been increasing over time. There's never been a recorded period actually where they had more cash actually than debt here, but the net debt is positive, which means that they are carrying some debt here. However, seeing in the orange here, we can see for the most recent quarter here that the cash from operations is much more than the net debt here, so they can pay off the net debt basically anytime they want here, concerning the cash flows at least, which is very nice to see. However, this type of gap here that we see if we go back just a few years is kind of alarming, where we saw a increase here from 2021 to 2022 in terms of the gap increasing, and this is never what the investors like to see, and certainly not speculators or investing or investors looking from the sideline looking into this company, because this is worrisome. But here they fixed it, as I mentioned, so this looks very, very good right now. Nothing else to add here. This paints a similar picture as we saw previously on the net debt situation. So this is the net debt to EBITDA here in this case, and we can see that it is quite low at 0.4 times multiple here, which is very, very nice to see, especially for an industry company here. So, and looking back, they've have had figures or multiples here that were much higher. So management has done a very good job here to keep the number low, and I think this is especially strong going into this situation where we have a lot of cost inflation, we have a lot of worry in the market, what's going to happen and so on. And it's very good to see that this company has a very low net debt to EBITDA level. Obviously, it's not negative, which would have been better, but it's certainly not high. And especially here, we saw that they had very strong cash flows as well from the operations. So the health of this company looks pretty good right now, I would say. And also comparing it to some peers here, just comparing it apples to apples and nothing else. We have AdTech here at 1.5 times and Indutrade at 1.7 times, which is certainly much higher than comparing it then to that of AQ Group right now, which only sits at 0.4 times. Now looking at the EV to EBIT multiple, again, sits very low here at 11.6, which is low, even historically speaking here. We have to go back all the way here to 2015, 2014, where multiples of many companies were much lower. So we can see here that the company trades at a pretty fair value. I'm not going to give any stock tips or anything like this, whether this is a buy or not, but it's certainly much lower, even comparing it to its own multiple. So yeah, and here we can compare it here also to some apples to apples here with some peers. AdTech that sits at 20 times and Indutrade at 19.5 times, so almost twice that of AQ Group right now, which indicates that AQ Group sits at a much lower value proposition, just looking at the EV to EBIT multiple. I'm sorry. Now for the dividend development per share here, and also for the dividend guys here who are interested in the dividend yields and so on. Looking over time, there has been some development for some years, but if I could summarize AQ Group's dividend policy or dividend, track record. I would rather say that, inconsistency is probably the right word here to choose, because we see here that they haven't had any dividend raises here. The board has been very conservative, and we can see here for 2019, 2020, there was 0 dividends paid out for those years. We can also see here for 2021, 2022, the dividend remained the same, even though the dividend was higher here comparing it to 2018, and then they raised it to 3.3 or 3.33 kroners each per share. But consistency is not really their thing here for the board, so very inconsistent. But maybe they are defending their balance sheet or something like this. It's probably why they kept the dividend low, or dividend raises here low, and we can see that they currently only have a 0.74 dividend yield here, so quite low dividend yield for the stock right now. Now for the CEO remark here, and this is what I really like. So this is a summary, it's not the whole letter, but I chose which points to take out here. So he's saying here that they have still some struggles here, to deliver in time to their customers. He also says here that some customers are not satisfied with the quality that the company is delivering, and also they have some issues here with the precision here of delivery, so not delivering in time most likely then. He's saying here that they are investing to the smartest, or into our smartest co-workers here, to improve our quality and delivery performance. He's also saying here that his assessment, though, despite all of this, is that they have good potential here to keep on growing. And this is based on, that they're active within electrification and energy cost savings here. So they are in the right environment here to keep on growing. So, there are some challenges that he pointed out here. So I think that investors should be mindful, that they could potentially, we don't know, but could potentially lose some contracts here because of the lack of quality. But then again, he's also confident then that they will be able to improve on this and will be able to keep on growing. So it's a little bit of a mixed bag, but I would lean more towards the positive points here. And especially since the numbers, the figures that we saw here in the most recent quarter looked really, really good. So, I think this company could be worth, taking a deeper dive into. I don't hold any shares right now. I will investigate this company a little bit further. What I didn't like was the share price development. I think the share price had increased by like 44% in just this year, so year to date. So, but still, from the metrics that we saw previously, I think it was like 11 times EBIT to EBIT multiple. It doesn't really scream overvalue either. So, this could be worth looking into. But as I said previously, I don't own any shares right now. Just a speculator, looking from the sidelines right now. All right, this was it for this video. Thank you very much for watching. If you liked the video, please hit the like button and subscribe for more content. Thank you very much for watching. Goodbye.